Hi, everyone. I'm John Mark Young, and this is the Whitaker-Myers Wealth Managers Question of the Week video. This week, we're going to dive into a piece of advice, maybe a question from Rick Edelman. Now, of course, Rick Edelman didn't call me, but Rick Edelman is the president of the Digital Assets Council of Financial Professionals, or DAC-FP for short. He's also the founder of Edelman Financial Engines, which grew under his leadership, and again, he founded it, to one of the largest RIAs, registered investment advisors in the country, who manages over $271 billion in assets under management across 1.3 million clients. And what we're going to talk about is Edelman's research that highlights an intriguing idea for some investments that we're going to dig into today and talk about the why, the how, and what Dave Ramsey thinks about these investments. Now, here's his idea. It's this: that some investors, depending on their risk tolerance, their time horizon, their risk capacity, how much risk can they even take, might benefit from allocating just 1% of your portfolio to crypto or digital assets. Now, you might be wondering, why just 1%? Well, let's break down the value and the why behind his approach. And then again, we're going to talk about, what does Dave Ramsey say about that? Now, he says by dedicating just 1% of your portfolio to crypto, Edelman says you can improve your overall diversification, one of the main benefits. Now, here's how. Crypto assets like Bitcoin and Ethereum, they don't behave like traditional asset classes. Now, those traditional asset classes are like stocks and bonds. They have low correlation to the broader market, which means they don't necessarily move in the same direction at the same time as other investments. Sometimes they do all correlate together, but not always. So by adding even a small amount, you're actually reducing your portfolio's overall volatility, which is a pretty cool feature. Now, volatility and diversification, volatility reduction, or the attempt to reduce volatility and diversification is, again, this is not new. This is modern portfolio theory. This is saying, yes, you can do better when you spread things out. But there's also another reason why. It's upside potential. Crypto assets have experienced tremendous growth, as you've probably seen over the past decade, even with some pretty wild swings. That's why, and what makes Edelman's 1% advice so compelling, with just a small exposure, you have a shot at capturing some of that growth, which can have a big impact on your portfolio without taking on too much risk. Essentially, it's a way to give your portfolio a potential shot in the arm without overcommitting to any one asset class. But it's not just about the numbers. Investing in crypto also means you're supporting innovation in the U.S. economy. Blockchain technology and digital assets could be transformative industries. And in some ways, we're already starting to see them transform industries from finance to healthcare to supply chains. By investing in crypto, you're participating in the growth of groundbreaking technology that could reshape how we live, how we work, how we interact. You're not just an investor, you're part of innovation. And that's why the Triple Q's investment that so many people invest in has been such a popular investment. Be part of the innovation of the U.S. economy. Now, it's important to keep that 1% advice in perspective. Crypto assets are volatile and they're not for everyone. Now, let's ask the question, how volatile are they? What exactly have you been signing up for historically when you've invested in crypto? Well, let's just use Bitcoin as an example. Bitcoin is significantly more volatile than the S&P 500, the 500 largest companies in the US, or growth and income in Dave's world. Now, how more volatile has Bitcoin been? Well, Bitcoin's volatility has often been around 4 to 5 times that of the S&P 500. Here are some figures to provide you the context around what that actually means. So when you think about volatility, the annualized volatility of Bitcoin typically ranges between 60% and 100%. Now, contrast that to the S&P 500, where your annualized volatility is typically around 15 to 20%. So obviously, a lot more volatility. That leads to daily price swings that are significantly higher. Bitcoin can experience daily price changes of 5% or more, and that happens relatively frequently. It's not uncommon to see swings of even 10% in a single day during periods of really high market activity. For the S&P 500, daily movements are usually within a range of 1 to 2% on most trading days, and or smaller than that, and swings larger than this, the 1 to 2%, they're considered rare and are often tied to major economic events. Now, what about when it gets to crisis time, that's when everything starts to blow out. Well, during periods of extreme market stress and volatility, like the COVID-19 pandemic onset in March of 2020, Bitcoin's volatility spiked massively, with some days seeing 30 to 40% swings. The S&P 500, even during major crises, typically does not exceed daily moves of around 10%. Again, that's extreme, although extreme events may cause it to reach similar levels. Although in today's world, we have these gates that kind of turn off the market if it gets too crazy. Now, Bitcoin's higher volatility is mainly due to its emerging nature, the fact that there's lower market liquidity compared to like the traditional markets of the bond market and the stock market. And it's got a lot of sensitivity to regulatory news, macroeconomic factors, and even investor sentiment sometimes. But if you're looking for a small way to diversify and try to add some upside potential, and like we said, be part of the tech future, Rick Edelman's 1% strategy might be worth considering for you. Now, all that to say, let's talk about what my friend Dave Ramsey says about Bitcoin. And the last time I heard him talk about this was back in March of this year when he was on the show with George Kamel. And by the way, I'll put that video in the comments of this video if you want to watch it and kind of see what he says for yourself. But he absolutely, through that conversation, being asked by a caller, said no to Bitcoin in his opinion. And he cited things such as Warren Buffett, and Warren Buffett won't invest in it or touch it, and the fact that it has no income generation or profit motive as a stock does. They cite that they do hear from proponents of digital assets and blockchain that says, hey, this has a functional technology that will improve humanity, but they don't see where that's happening. And so I thought, well, let's actually look at two basic ways of how blockchain technology is today, right now, out there improving your life, even though you might not know it. And the first is supply chain transparency and traceability. Blockchain is currently revolutionizing supply chains by providing transparency and traceability from production to the end consumer. You have to understand blockchain to understand how this works. But for example, major food companies like Walmart, they're using the blockchain to track produce, to track meat, to track dairy from farms to stores. And with blockchain, each step of the supply chain is recorded immutably, ensuring that consumers can trace the origin of products and verify the authenticity. They can verify things like sustainability practices and food safety. And this reduces fraud, enhances food safety, and allows consumers to make more informed choices. Think about when we have some sort of food issue, salmonella, something like that. In the past, we had to take that food back from a broad regional area because we just didn't know where it came from and where it went there. We kind of knew generally, but we didn't know at a very specific level. Now with blockchain technology, we can know very specifically, and we can take that bad produce, that bad meat, right out of the specific store, concentrate the issue, and not waste all this other food that we just didn't know. Now we do, thanks to blockchain technology. The second thing and reason why blockchain is actually helping us today, or helping people today, is financial inclusion through decentralized finance, or DeFi. This might be the whole reason why Bitcoin was created back in 2008. Decentralized finance, or DeFi, uses blockchain to provide financial services without traditional banks, without the government's intervention, without them getting their hands on your money and tracing your money. Through DeFi platforms, people can borrow, they can lend, they can save, they can earn interest on digital assets directly on the blockchain. This is especially impactful, not so much for us in the US, but in regions where access to banking is limited or the government currency is very volatile. This allows millions of unbanked individuals to participate in the financial system. They can secure loans and they can grow their savings. DeFi helps foster financial independence, creating new opportunities for economic growth globally. While with traditional finance, a legal immigrant to the United States that wants to try to send money back to their family in their home country, and many legal immigrants do this. They come to America for better opportunities, for more pay, and then they send it back. Well, when they do that, it takes nearly 5 days and costs as much as 5% when dealing with wire fees and currency exchange rates. However, through DeFi, that transaction can happen nearly immediately without the costs of traditional banking. So to be clear, this is not a commercial for Bitcoin, Ethereum, or any other coin or blockchain technology. Rather, it's an opportunity to have you learn about, think about whether you believe in the technology, how you should think about it in relation to your portfolio, and if you want to be an investor. If you don't understand it or you don't believe in it, that is your number one sign you should not invest in it. Always remember, do your own research, consult with your local financial advisor, and make sure any investment aligns with your goals, your risk tolerance, and your personal beliefs. That's the key. When you invest in something you believe in, you know about, you're educated about, and you're comfortable about, you make better decisions and you make better long-term decisions. When I invest in something I don't know about and it starts to do things that I feel are outside of the normal expectation I had, that's when I freak out, and that's when I start making bad decisions about that asset. But when I'm educated, I'm aware, then I can know what to expect, and if I believe in it, even during tumultuous times, I'll stick through it because of that belief. So that's why, again, we would encourage you, if you believe in that asset, maybe you would follow the Rick Edelman strategy of allocating 1% of your portfolio to digital assets or crypto. And if you're not educated or you don't believe in it, then you just simply walk away from it, or if it's beyond your risk capacity or risk tolerance. Certainly always something you can talk to your financial advisor about. They'd be happy to educate and teach you about. So thanks so much for watching this week's video. If this week's video was helpful to you, would you do us a favor? You can do us a favor by hitting and smashing that like button and that subscribe button. When you do that, it pushes our content out to more people on YouTube and Rumble through the use of algorithms that say, hey, this content was helpful. That's why they hit that like button. Or when you hit the subscribe button, you get our content pushed out as we release it, including we're bringing back our annual market outlook for 2025. Last year, we had one of the top economists at First Trust join myself in November. We're going to be doing that again this month, in the month of November. So be on the lookout for that invite in your email through our weekly newsletter, and we'll send a specific invite out for that in a few weeks here. That will be middle of November, and we are very excited to have Andrew, our economist from First Trust, back again to talk about the markets, the economy, and what their expectations are for 2025. It's going to be a great conversation, certainly something you don't want to miss, because it'll be post-election, so we'll have a lot more framework on what's the economy actually going to look like under the leadership we have with the new Senate, new Congress, and new president. So thanks so much for watching this week's video. We'll look forward to seeing you next week.